talking to. Just know I ain't no regular fool. Could be anything in the world, but I can never be you because I stand tall like I'm on my tiptoes, baby. You think a little too small. I got big.
Good morning, everybody. You're watching SmallCapSteve Live. I am SmallCapSteve. I am thrilled you could all join us this morning. It's just going to be me and Jay. We're just going to talk. I don't know what we're going to talk about. I'm just sitting around eating turkey, watching Blue Jays baseball. Julian Merriweather hit 100 on the gun multiple times yesterday. That's why I'm wearing my Jays hat. GameStop announced that they're going to raise $1 billion. That's pretty big news. Going to get into that and more. So buckle up. Let's get started.
I worked too hard for it.
Jason Lutz, the love of my life. Welcome to SmallCapSteve Live.
Hey, how's it going? What'd you do this weekend?
What an intro. That's a tagline. What did I do this weekend? I actually, since COVID started, I was drinking way too much alcohol. I was probably getting relatively drunk at least 3 or 4 times a week. I just, you're sitting at home, you're bored, there's nothing to do. I've stopped drinking recently, but I had a few glasses of wine yesterday. I've actually started vaping, which is totally new to me. And this is the Ace Valley vape pen. And I actually do it. It helps me turn my brain off. You know, the kind of work we're in, how hard it is to sometimes shut it off. That's a big problem I have, is falling asleep at night. I've got so many thoughts and I'm trying to organize that. I think in large part that's actually why I like to drink, is it really helps disrupt that sort of like, oh, I'm obsessing over, some idea or some stock or something. I've started to try to use vape pens to do that. And you know what? It's actually working a bit. It's helping put me out at night. So kudos to the Ace Valley vape pen.
Ace Valley. They got, you can't do that. Now you're supporting Canopy. They just got bought out last week.
Hey, Bruce Litton was on the show last week.
Yes, but it's not Bruce anymore.
He's still on.
We love
shares.
Bruce.
So what do you want to start with today? There's been a lot going on in the news. I'm gonna be honest. On the weekend, I probably read over 15 articles about Archegos and Billy Wong, and what I found really fascinating about it was that there was probably over 5 of the articles had in the title, "How Billy Wong amassed a fortune of $20 billion. And then you read the article where they try to walk through the mechanics of what he actually did. And nobody really knows, right? Like you get the odd anecdote in each article, like, okay, after his previous fund blew up, he still had like $400 million left over, put a ton of it into Netflix and Amazon and made a bunch of money. And then that gave him the leverage to get started. But I still think that that's, somewhat speculating on what actually happened here. And I would love to find out more about how he kept going to different prime brokers, as they say, and they kept leveraging him up. And I don't believe for a second that they all didn't know what they were doing. And of course, leave it to Goldman Sachs, who's always known to be kind of, for those of us who aren't from the investment banking world, we always hear of Goldman Sachs in terms of like, they're the most, what's the word I'm looking for? The
Ruthless.
Yeah, they're the most ruthless. The plug on them and Morgan Stanley. So who knows what ultimately caused that, but it's definitely something I feel like there's certainly going to be a movie made about in the future, and I can't get enough of it.
Nothing's going to top a Wolf of Wall Street movie when it comes to stuff like this. So that's just how it is, right? It's going to be hard to top something like that. So I mean, whether or not it actually turns into a movie is a good question.
Mm-hmm. Yeah. So let's start with the big news this morning. GameStop, I'm hearing, raised some dough. Did you guys cover that on the live?
That's not quite exactly what it is. They announced an at-the-market equity offering. They actually phrased it really weird, and I did cover it this morning.
You're gonna cringe when you see what I put on the headline for this video. Then let me see what it actually says. It says GameStop finally looks to raise money. Would you
that's accurate.
Okay. This is. I'm gonna have to get a subscription to the Globe and Mail. Let's try.
Or just a deep dive because we did cover it.
You guys covered it. Okay. Look, I'm so trying to figure out what's being covered everywhere that. Just let me pull this up here, Jason. Hold on one second.
It's the second article that was out this morning, right after True Leaf.
You wite so many articles, I can't even keep up.
Someone's got to get shit done.
Good on you. Okay, here it is. And see, your title, this is why I think the deep dive does such a great job, is the put together for us pretty much tells us exactly what we need to know in one headline. And so many other headlines you read, and I can even pull it up on Google News if you want. They just like they're trying to add a little bit of opinion or a little bit of flair to it. Oh, the stock dropped. And no, I don't care what the stock does within a 2 hour period on something this volatile. Don't care. Okay, so GameStop announces ATM financing capped at $1 billion and 3.5 million shares. It may have taken. I'm going to read your piece if I may be so bold.
Go for it.
It may have taken far longer than anyone anticipated, but GameStop, whom has been the focus of Wall Street bets for months, has finally announced it will be raising money. The company this morning announced an at-the-market financing that will be capped at 3.5 million shares. Well, the company phrased the offering as being capped on a share count basis. The firm also indicated that the financing is not to exceed a total of $1 billion in gross proceeds. The offering is to be conducted through that of Jefferies LLC, with common shares of the issuer sold directly on the New York Stock Exchange to investors. So that means, Jay, correct me if I'm wrong here. You are the guru, as they say. This effectively means that if I, SmallCapSteve, I'm just a retail investor, I log into my discount brokerage account. Perhaps it's TD Online. Perhaps it's Robinhood. Perhaps it's Wealth Simple. I log in and I find myself buying shares of GameStop. That means that I actually might be buying shares directly from the company, who's then going to take my cash that I've just put into this stock and put it onto their balance sheet. Is that correct?
Yeah, that's probably the perfect summary. I think I often wonder why it's called at the market. Sometimes I think it's just because they wanted the acronym of ATM, which is effectively what it is for the company. They sell shares and money comes in, right? Just like an ATM machine. But yeah, so this financing was structured a bit weird. The company didn't phrase it as being 1 billion as a hard stop. Instead, the hard stop is 3.5 million shares. So if they sell 3.5 million shares at $1, they're only bringing in 3.5 million. Whereas most just cap it at the actual size of the offering, which would be 1 billion.
Is it fair to say that the bigger question here becomes, now that they have opened up Pandora's box, that this, like, we could be hearing, let's say that this goes smoothly, they're going to go back to that well pretty quickly?
I would hope so, but I mean, they took so incredibly long. I think they actually did a disservice to their actual shareholders by not doing a financing earlier. Like, it doesn't make sense. They were hard hit by pandemic, everything else. They had all this buying come into their equity. Sundial is effectively a SPAC because they were smart about it. And then you got GameStop, which was the #1 meme stock for literally now 2 months. And now they finally announced they're doing it. It's only 3.5 million shares. Like, I hope they hit the repeat button so that they can make something from this. If they don't, it's just poor management all around.
Yeah, so why don't I pull up some of the recent numbers here on Y charts? Would that be a fun activity?
Sure, go for it. We'll see how accurate Y charts is this time.
Yeah, they're usually. I've been giving them crap, by the way, and I'm curious if they watch the show, because I shat on them the other day, and then the next thing I know, they messaged me after the show. Steve, how's your experience going with Y charts? I'm like, yeah, it's good. It's not very happy. Half the time I pull up data, it's not there, and it was sort of like
half it's wrong.
It's kind of like, you don't even know, or sorry, let us show you all the applications that Y charts can bring you. I'm like, I'm paying you for data. I need the data to be there when I go to pull it up. If it's not there, then I don't know what I'm paying you all this money for. I'll get a Bloomberg terminal, I suppose. I guess the joke's on me for cheaping out. Okay, so in annual 2021, GameStop did $1.2 billion in gross profit. Net income amounted to $215 million. Now, you know where I like to go. I like to go to the cash flow statement.
Those are declining numbers. Holy man.
You mean the cash flow from operations?
Their gross profits quarter after quarter were just sinking.
Yeah. Let me go back here.
So look at that. 2016-01 was 2.9.
This is annual. This is annual. You want me to do it?
Annual. Either way, it says the same damn story, right?
Yeah.
Like that's not a good look.
But at the end of the day, they somehow on a trailing 12-month basis, and this is up to January, so this includes most of the COVID period. They are generating positive cash flow from operations. I don't think that from an investing standpoint they're positive. Okay, they actually lost money from financing. That's because they paid off a bunch of debt. GameStop. Now let's pull up the key stats here. Key stats brought to you by Tim Hortons. Just kidding. Tim Hortons is not sponsor of the show. Don't sue us. We could see here that they do trade at a market cap of $13 billion based on $100 million in trailing 12 months cash flow from operations, which is, what does that work out to, Jay? About 130 times. Yeah. And we could see price to sales ratio for you cannabis investors. We'll look at the price to sales ratio, which is the narrative that cannabis companies want, by the way, because then they can do more shady stuff like acquire distribution companies.
Well, and on top of that, they report their gross before excise tax.
Yeah. Okay. Well,
there's plenty of ways to get this.
I shouldn't have opened up that door, because I know that you could probably talk for an hour about just all the games cannabis companies play. In fact, you were working with some of our junior staff this morning, walking them through news releases in the games companies play with words, with linguistics.
So potentially non-dilutive convertible debt financing. That's something too on.
Who put that up?
That was Cytodyne. The same company that's the company that our young Justin himself was critical of and got him on the short mafia for.
Young Justin made the short mafia for bashing Cytodyne. Is that what I'm understanding?
Yes, that's my understanding of that whole backstory. He had like one tweet on it. He ended up on this short mafia thing.
A potentially non-dilutive convertible debt financing. That is, so I assume that the logic. Let's pull up that news release here. Just like let's.
I have it handy because I'm training a new group of staff members. Where is it?
Here, I think I found it. Let me pull it up for you there, Jason. Have no fear. Have no fear. Small Cap is here. So there's a Cytodyne, which is like generally regarded as an attractive short for all you short sellers out there. Cytodyne completes 28.5 million convertible note financing with conversion rate at $10 per share without warrants to accelerate manufacturing of leronlimab inventory, whatever that is. I know just some people that I've talked to are not particularly bullish on this story or the merits of what they're doing. I actually know nothing about it, so don't sue me regardless of what I'm about to say here, but I am about to shit on your news release. So where does it say potentially non-dilutive? It
actually says it, third line. I'll read it for you. Cytodyne, a late-stage biotech company developing linear a CCRS antagonist with the potential for multiple therapeutic indications, announced today it completed an additional potentially non-dilutive convertible debt offering with an institutional investor.
That is great. That's got to be one of your favorite.
That has to go on the wall, man. Like that is just hilarious.
We should create like a top 10 list or even like in
Top
just
10 wall of shame of fame.
And this one has to make like, of course, convertible debt is potentially non dilutive, but how many times have we ever seen that happen?
Probably, like, speaking to cannabis again, just because that's where we were born and raised effectively, probably 25 at least companies did convertible debt deals, and maybe 20% actually paid them off. That'd be high odds.
But you're talking paid them off, rolled them over into new convertible debt, or found cash elsewhere to, because like if you have to do a new equity financing to prevent that particular financing from being dilutive, then I would say that it wasn't a.
It was, yeah. Well, exactly. It depends how technical you want.
Especially if there's warrant coverage. There wasn't warrant coverage with this, was there?
So this is OTC, so they live by different standards. If you pull it up, one thing I'll point out is the first paragraph says 25 million, headline says 28.5 million. So that tells me they paid 3.5 million in fees.
This
you see that?
Yeah, 3.5 million in fees. So,
but they don't actually address it anywhere in there, so you miss it otherwise, right?
Mm-hmm.
3.5 million in fees is like more than 10% in fees.
If let me pull up the chart here now that I got some charting software that I can share. Here we go. Look at this. So this is Cytodyne's 3-year chart here, brought to you by TD Securities, not an actual sponsor. Just I figured out that I can use them for my charting rather than before I was just pulling up like CEO.ca's charts, which is
CEO would not work on this name anyway.
Yeah, which is pretty bush league on my part. It goes to show you how much I actually pay attention to charting. So we can see here, the stock was generally trading, in that what appears to be that sort of 50-cent range for the longest time. And then COVID happened there in March, April, and then the stock just kind of started to have some fun. Let me break this into here's a 3-year. You can kind of see from there. Let's go with
this thing's up 22% on this news.
And here's a 2-year. So it's not that bad for Cytodyne. I still don't know what they do. I don't really care that much.
Something related to
I'm over the COVID stocks. I to be perfectly frank with you, I was over the COVID stocks 6 months ago. I don't understand why anybody would buy them other than the degenerate gamblers out there that think that there's still hope for these things. In the end, I mean, vaccines are being rolled out all over the place. The Pfizer vaccine has tremendous, and Moderna is the other one that have like just crazy success rates. I'm not suggesting that our world's going to go back to the way that it was before, but I think that if you are a company that is embracing a COVID solution, it's probably over. Would you agree with that statement?
The COVID trade, in terms of COVID related services providers, it may not be over, but if it's not over, the timeline on it is very, very thin. People will say we're entering a third wave right now, renewed lockdowns, yes, but also look at the population that's being impacted. It's no longer really the 70 or 80-year-olds or even the 60-year-olds. And why is that? Because they've already been vaccinated. So right now there's a focus on the 40s, 50s, 30s, whatever. But that's just because those are the age brackets that were the least high risk for the original strain. May not be the case for the new ones, but it's just a matter of that's who's not vaccinated. So to me, it almost shows that things are working based on the numbers of who's getting infected in terms of age grouping. So to me, that tells me that the COVID trade's probably over. And at this point, people are going to look to position their money in terms of inflationary assets or assets that are expected to have a solid bounce upon reopening. So restaurants and air travel.
And by the way, I'm going through my news feed this morning, and it's just, there's been a few articles written about this, but the service economy is starting to rev back up online. So that's, to me, if we're going to see velocity pick up and that inflationary scenario, which I know that it feels a little bit like the Chicken Little scenario, tinfoil hat, whatever you want to call it, to be constantly running around saying inflation. This is basically it. If you can create inflation from money printing, I think we're going to find out in the next 3 to 6 months. And in some ways, we're already seeing it. I saw somebody tweeting today that it was actually Christopher Mullen from Tech Traders tweeted this morning that he went to buy a piece of plywood that used to cost $30. Today it's $80.
Oh, don't even get me started. The price of wood is ridiculous. Like, I was planning on building a deck and all kinds of things, and I just said piss on it because I'm not willing to pay 10 grand for a tiny ass deck. It's really what it comes out to these days. It's ridiculous, but it's just the whole. There's no inflation. Well, here's your inflation, right?
It's turned into a common talking point too. If you're watching CNBC Fast Money and perhaps Tim Seymour and his other buddy there, whose name escapes me. They are, a little bit of a groupthink thing going on, but it does feel that we're hearing the rhetoric more and more often, and the economy, other parts of the economy clearly boomed during COVID, right? And I was saying yesterday to a friend of mine that I'm actually kind of disappointed that we're going back to normal, because I've rocked the last year. It's so nice to not have to hop in a car or hop in an Uber, head downtown, meet with, go to a meeting, and like you sit down at the meeting and the person you're with orders a drink, and it's like, and Jay, I know that you're a bit of a hermit, so you don't know how this feels, but
I get it. No one likes to be drunk on a Wednesday afternoon.
Let me finish. The problem is that you sit down for that meeting, and that person that you're about to meet with, they order a beer or a glass of wine or a highball, whatever they want to order. And, they say to you, like if you say to them, I don't drink, or I don't drink on, you can't say I don't drink on a Wednesday, because now you're going to make that person feel bad for drinking on a Wednesday. But if you say you don't drink, they'll say, yeah, it's okay. But you know that like this meeting's not going to go that well. And you want to connect and bond with this person that you're meeting with. So you have a drink, and then the next thing you know, you have 3 more. You're structuring a deal, or you're networking, or you're doing whatever the goal of that meeting is. And suddenly it's like 4:00 and you're heading home half in the bag. And I actually hate that. I love being able to just go from Zoom meeting to Zoom meeting to Zoom meeting. And occasionally you get somebody who sends you like a Skype or like Google Hangouts, and you're just like, what's this?
What is this?
And it's been wildly productive. So what I'm really getting at is certain parts of the economy really, the productivity increased massively because people were able to engage online and host those meetings. Whereas the general service and travel sector just got totally obliterated. Now we're going to see both of those come online. The question is, how much are the services going to take out of the other sector? Well, the rest of us were working our butts off, and those of us who have subordinates are yelling at them when they're not working at 8 p.m. on a Saturday night. How much are we going to go back to normal and start to go to restaurants and have drinks, or hop on a plane and go I don't know, harpoon fishing?
Have you ever gone harpoon fishing?
I said tarpoon fishing. That tells you how often I've done it. But that's
yeah. I mean, to me, my big takeaway from that whole thing is like I much prefer just hopping on a video call. One, because when you go downtown, it's tough for me to be in the meeting, given that I'm literally a couple thousand miles away from you, versus Skype or Zoom or whatever service you want to use. It's nice and easy, and it makes it more efficient. But I mean, hopefully people just start to take the weekend more as personal time, and during the week it's all production. productive and still online. That's really what I'm hoping. I love being able to crawl out of bed and in 10 seconds I'm at my desk working away. I don't got to commute 45 minutes to town to sit in an office for what I've come to realize is pretty well really no reason. I'm not a huge fan of the office. It is what it is. Sure, you miss some social aspects, but I'd much rather spend time with my family anyways, right? So,
that's something that I commonly hear, and is this idea that some people say you have to have your workforce in the office so that you know that they're actually working. And then there's some people who, they're not micromanagers, and they say, I don't care where you are, I just want you to work. Whether you like, if you're more effective at your own home with 50 screens around you and, occasionally going down and seeing your family, then go for it. That's going to be a big question. And, early on in COVID, there was statistics coming out, and don't quote me on this one, but it was something along the lines of how BMO plans on having 80% of their workforce that's, goes to the corporate office remain stay-at-home work, because they started to see how productive it was, and because it is really silly when you think about like this whole concept of in the GTA, most people who are working downtown, I would hypothesize, they look, obviously this is Toronto centric focus, what this comment I'm about to make. So apologies, Jay. I know you're rolling your eyes, but if they live in, say, Burlington or Barrie or Oshawa, you talk to any of these people, they always tell you, oh, I'm an hour door-to-door commute. It never is the case. It's never the case. It's usually an hour and a half. You got to get in your car, drive to the GO train station, and then you got to walk from your car to the GO train platform, which is usually a 10-minute walk because these parking lots are massive if you've ever been to a suburb. And then you got to take stand on a platform, presumably 3 to 5 minutes early because you don't want to miss it. And then you got to take a GO train, probably 45 minutes. And then now you're at the Union Station. Now you got to go get from Union Station to your office. So that's probably 3 hours a day that people are spending going from home to work and then from work to home. That 3 hours, 15 hours a week, these are quality hours for you. You're awake. You could be doing productive things, but instead you're kind of like, it's like you're sent to prison for 15 hours a week. I mean, I know a lot of people listen to podcasts, and if you're listening to SmallCapSteve live, I thank you. But the reality is that there's a lot more productive things that you could be doing other than like sitting shoulder to shoulder with some stranger, trying to stay quiet and not be a nuisance because everybody's so polite. And that's something that I actually think that I hope that for those of you who are more productive, you have employers that allow you to ditch that part of your life, because it really sucks. And I can't imagine having to get up and deal with a commute like that every day. But we'll see as the economy comes back online. I'm not even talking numbers here. I'm just looking at anecdotally or empirically what I see around me is that people who work in certain sectors have been crushing it because everybody's working, everybody's productive. And now we're about to sort of see the economy roll out as we move back to normal-ish, as I like to say. And we're going to see, does velocity start to pick up? Do we start to see those inflationary pressures? And ultimately, how do you play that? You and I made big bets, big bets on the on the junior gold names. And as Rick Rule told us, the challenge with doing that is that you end up in a position where you have all these, but then the majors don't go. Forget about it. Like it doesn't really matter what results you put out. Like forget about the Great Bears of the world, because that's backed by Rob McEwen, who basically could do whatever he wants with the stock. The rest of the juniors are kind of So I mean, perhaps we would have been smarter to play with the big names, which is something I think about a lot. It's hard when you work an hour line of business and you like helping venture stage companies. But I still wonder, some mornings I get up, I'm like, man, should we be trying to buy more gold juniors?
It's funny you say that. When you were on one of your rants earlier in the show, I was looking at the price of some gold juniors I might buy later today. So My thing with gold juniors is you always like investing in general. You buy when no one else wants something, and why? Because that's when it gives you the best return. Right now, sentiment for gold juniors is in the shits, man. It's terrible, right?
Mm-hmm.
Compared to a year ago. A year ago, we couldn't get off the phone to save our lives because there's just one call after the other, and now gold juniors just aren't really calling because gold is at a great level, but mentally it's at a terrible level because we saw $2,000 gold, right? So
the trap, sorry for interrupting you there, but
go for it.
The trap that I fall into, and it's something that I started to think a lot about, is when you play in the venture and junior game where you are as intimately involved in it as we are, where you're waking up, you're following all these stories. You can see Jay here is even writing about some of the OTC names for crying in the mud. The thing that I tend to think a lot about is, should we be thinking about bags? And I'm not going to name the CEO who once said this to me, but he goes, "Look, kid, it's all about the bags in this market. How many bags are there in a stock? That's all anybody cares about is bag us. We want lots of bags." And it did get me sort of thinking of, like, should we be looking at those gold juniors or those super, commodity names, super cycle commodity names, trying to find those, 5 to 10 baggers, as opposed to just trying to hit those singles and doubles?
Yeah, but you're a baseball fan. How often is a home run hit, and how often does a guy get on first base?
I love it when you talk about sports analogies. And it's true. We've been very lucky to hit a bunch of home runs in the last year because it's just a good year. Look at 2000. And so right now we've got a little bit of a recency bias that it's easy to find those 5 to 10 baggers. But my whole thesis is, are you better off trying to find things that you think could be 5 to 10 baggers and exit when they're like 3 or 4 baggers? And then be on to the next one? Or am I making this sound like it's just that a lot easier than it actually is?
I think we have been spoiled over the course of the last year, right? If it were easy to double your market or your money or more in the market consistently, no one would work because you would just play in the market, right? 2020 was something exceptional. We had some elected officials south of the border that really, really pumped the market, and that just brought everything up, especially as people search for yield, thinking that the larger names weren't going anywhere anymore. But I think we're suffering from recency bias a bit. I mean, to me, the process of, this is a potential 5 bagger, let's sell it 3. To me, that makes sense. To a lot of people, they go, well, we're giving up a large part of your potential gain. And the fact of the matter is, I'm comfortable with a 3 bagger. Could it go to 5? Yes. Could it go to 1? Yes. Right.
Can I bring up a story that you covered this morning that I thought it was fascinating. So that's the whole reason that I want to bring this up. But it's this Afria story here that Afria reports independent proxy firm approves of Tilray merger. I'm curious here what this actually means, because I tried to spend some time looking into these firms and what exactly is their role, and why would they suddenly conduct an independent study of this transaction and then release this information? They clearly were compensated by somebody here, and it just, to me, like, basically everything about Avria and Tilray doesn't pass the smell test for me.
So
what's your take on this news?
These things are always called independent proxies, and independent in the sense of I don't have shares in either name, long or short, so I'm independent. Let's face it, they were definitely paid by someone to provide their analysis on it, so that would either be Afria or Tilray. And I mean, I think it's a larger issue than this, actually. Michael Miller actually always comments on the compensation committees and the third-party advisory firms that they use to justify their compensation. So basically, you pay these third-party advisory companies a large enough figure, and they'll make whatever number in the world you want to work, right?
If I had the time, I would spend more time investigating this, because this just doesn't make any sense. Why would these two companies take the time to analyze this transaction and then come out with a positive report? This just screams like, hey, we won an award, and then you don't mention the fact that you made a donation to the award show that that nobody mentions as a sponsor of said award show. Like, I don't know exactly the mechanics of this, but when I read this, and I actually didn't even know that you covered it, and I was like, I was going to send it to you this morning to cover. I saw it on BNN Bloomberg, and I was just sort of like, this is bullshit. So I'm not going to send it to Jay. And then here I pull it up, and you actually covered it. So sorry, Jay. Go ahead.
So here's the perfect analogy. Mining. I know we've talked about mining already, but I'm going to go back to it actually. What is an NI 43-101 report? It is a resource estimate conducted by an independent third party. Independent or not, that independent party was still paid by the company to conduct the analysis and come up with that number. Right? So there's actually, in terms of mining, there are independent parties out there that are known to produce rosier than they should be results or estimates, right? I'm willing to bet that this whole proxy thing in terms of getting share or independent review is exactly the same. A free or Tilray is still paying them to conduct the review, but they're able to say they're independent solely because they don't hold shares or anything. I'm willing to bet that's what it is. So they were paid by a free or Tilray to conduct this analysis, and then they go, oh yeah, this works great. Well, how independent can you be when you're being paid by someone to do something?
Yeah, that's like a fair point.
I'm being careful what I say so that I don't get a lawsuit thrown at me, but
yeah,
I feel like it's a numbers game.
Yeah. Well, look, I mean, we're just getting our commentary and our thoughts on it. If somebody from the company's watching this and they take issue with what we say, we're always open to that sort of discussion. I just it doesn't make sense to me why a proxy. I've never even heard of these two companies. It's just not something I care about.
Lewis is always coming up.
Always. Oh, is it? Okay. Oh, yeah. It's possible that I've read it before. It just didn't pass the basic XML test. Next, I'd like to bring up a tweet that you sent me this morning here from Rudy Havenstein.
So Rudy's a great follow. He's extremely sarcastic, I will say that. And a lot of the times he gets bored with the markets and he makes up shit. And it's actually hilarious, which is why I follow him. So he's a great follow. But then he also comes out with stuff like this, which is really, really good. So I don't know if it was this morning or yesterday or whatever it was, but he highlights after listening to a podcast with some CNBC guys on whatever show it was, there were some comments related to the price of the SPY relative to M2 money supply. So basically what he's saying is he compared the stock market to performance once adjusted for inflation. Mm-hmm. Or sorry, money printing.
And here we have the chart. What does the chart tell us?
Tells us that this is the S&P.
Yeah, this is the S&P 500 large cap index as divided by M2 money supply. And it actually is like smack dab in the middle. It looks like this thing's, hit a low of 10 cents. It's hit a high of 32 cents. And here we are at 20 cents. Well, so it's effectively hit a low of 10. It's at a high of 30 and we're sitting at 20.
Let's rephrase that a bit. So look at the prior highs. We're getting near to 2137, which was the 07-08 bubble that popped as a result of real estate and everything else. We're getting close to what I can't see just because of our images there, but it looks like March.
Here, I'll take it off for you. Look at that. Is that better?
March. No, our images. My face, your face.
Oh yeah, I'll take them off. Look at that. Nobody needs to see our pretty faces. Here we go. There you go.
It looks like right before the crash last March, we were at 2187, which was higher than the 07-08 bubble. And then we just tumbled because of all of the freaking printing. That tells you how much money was printed. But we still aren't near the internet
It's
boom, which is interesting because it certainly feels like we are, but like we're a little over halfway there.
yeah. Well, I mean, the other thing too is gold was a lot cheaper there, and then gold. When did gold start running? If I pulled up the 20-year or 30-year chart of gold,
You know what? Let's see if we can.
let me see if I can grab that here for us.
Here, I've got a link for you actually.
Oh, here it is. So here's the 30-year of gold. And you can kind of see there right around 2000. So gold was pretty consistent there from like, it was trading around $400 all the way, $400 to $500 all the way from 92 right up through about 2006. It didn't really break out until
That's wild.
2008.
Down to 5x because gold is not something that should 5x like that.
But then when we go back to this chart here, we could kind of see that. So gold was kind of consistently trading in that $400 to $600 range, which I suppose is relatively volatile because if gold goes from 400 to 600, that is a 50% increase. But we could kind of see here that when you compare it to the large cap divided by M2, it sort of tells us that gold sort of stayed consistent, and the S&P effectively ran from 96, 97, or even if you want to start in 95. Almost 250% on a ratio relative to the ratio, and then came all the way back down to this level here. So it appears as though if you're buying into the thesis of this chart and you're a gold bug, then I suppose that this means that you ought to be cheering for the S&P to continue to increase because gold looks like it's sort of found these levels here where it's going to trade at about 20 cents on the dollar relative to the S&P 500.
So I actually sent you a link that does gold the same way.
Okay, hold on a second here. Let me pull it up there, Jason.
And you know what? It's pretty well the inverse.
Oh, this is this chart right here. So what is this chart here? Doesn't really. I yell at my staff when I see charts that look like this. By the way,
so this is gold to monetary base ratio.
So this is gold to the monetary base ratio. So gold's effectively at near an all-time low. It kind of hit that all-time low there of gold to monetary base ratio. So this interactive chart shows the ratio of the gold price to the St. Louis adjusted monetary base back to 1918. What is the St. Louis adjusted monetary base? Is that M2?
I imagine it's M2 adjusted.
So we can see there, we kind of hit that low there in September of 2015 until right up to April 2020. We got all the way up to 34 cents on the dollar, or whatever these variables are. It's hard to spend too much time on a chart when you don't actually know what the variables are. So I unfortunately.
Oh yeah, no, I hear you. It was the first thing that came up when I googled gold to M2.
But it is interesting, and it kind of shows us that if we're going to work from a confirmation bias on down, we can usually find whatever charts we want. Which what's his name? Tavi Costa had a huge article that showed up on Zero Hedge on the weekend that sort of went through all of his charts. I can pull that up if you want.
Yeah, pull it up. I missed it. Oh, I'll be honest. I've started taking my weekends off.
Oh God, we're screwed.
No, I like to limit myself to like 6 hours a weekend now.
Okay. Okay, so let's take a look here. This kind of just walks us through a bunch of their chats here. We can see U.S. households net worth to GDP has generally increased since the beginning of the pandemic. Commodities to equity ratios. This is sort of this idea here that according to this, which uses the GSCI commodity index relative to the S&P 500, this actually shows that we're basically at the lowest that we've been since the beginning of the chart. And that's, generally speaking, I find this chart for me is the most thought provoking one, where I tend to think about a lot. I would say that I think about if we are currently in an equities bubble, and we're looking for that argument, perhaps it's confirmation bias, but if we're looking for that argument that we're looking right at the next commodity super cycle, this chart tells me what I need to see to buy into that thesis.
Yeah. So here's the issue: we have seen other commodities go freaking nuts. Lumber, we were talking about that already, right? The cost of wood is just this world.
Stocks during inflationary periods. Sorry for interrupting you there. So we can see during periods of so stocks. So we can see what the Dow Jones Index has done since 1900, and when we've seen high inflationary periods, I think that what they're getting at is stocks actually tend to not move. Equities tend to not move during inflationary periods on a nominal basis. That's actually pretty interesting.
That's really interesting.
Tavi, look at him. The last video we did got massive views with Tavi.
Oh, look at that search popularity rank. Inflation.
This is what I love about Tavi. To me, puts together the best charts in the business. Yeah, let's talk about this briefly. So I assume that this is on Google Trends. If you type in the word inflation, if you go, I'm not going to do it, but if you go on Google Trends and you type in inflation, you know what? Let's do it, Jay. Let's show the audience how to use Google. Okay, so I go to Google Trends here, and then I type in inflation, and this actually doesn't look that crazy to me. But let's maybe go
past 12 months.
2004 to present. It certainly has been. It did hit a high there back in March of 2021.
That's a weird time for inflation to hit.
Yeah, and interest by region. The District of Columbia. Hey, the bureaucrats.
They're trying to figure out what inflation is.
That is
that's hilarious. That's what that is.
The moment of Zen for the show.
So
U.S. inflation expectations. The 5-year break-even rate is at the highest level it's been at since quantitative easing was introduced in 2008. Fed purchases of treasuries and mortgage-backed securities. This is the most we've seen purchased.
Doesn't that just look like it's flipping you the bird?
Yeah, but it's not really telling me a whole lot. Fed holdings of mortgage-backed securities, that's obviously way up. So, of course, housing's booming, and we're now subsidizing housing. U.S. marginal tax rate versus government debt. So debt's increasing, and this was my point. You and I argued a little bit about this during Biden's infrastructure speech. I don't see tax rates now. Look, they are going to raise the corporate tax rate to 28%, and Janet Yellen's already running around saying, "Oh, maybe globally we should have like a minimum corporate tax rate," which actually is a good idea. Like, if there's one thing that they probably want to collude on, it's having a fair playing field, so that, like,
isn't it funny how you and I can't collude on something, but the government can?
Oh, of course. Wall Street's 2021 EPS estimate. That's growth versus value stocks. So we can see they use the Russell 1000 growth divided by the Russell 1000 value. So this is generally small cap. And you can see here that growth was at an all-time high relative to value there in 2021. Growth stocks to GDP. Here they take the Russell Growth 1000 and they divide it by U.S. nominal GDP, showing that we are at that all-time high.
There's a ton of charts in here. Holy man.
U.S. 10-year nominal yield finally coming back up. Obviously, that's going to be interesting to see how that plays out.
Long term, you can see what the trend is.
Let me know if there's anything here you find interesting. Gold and silver miners, aggregate trailing 12 months net equity issuances. I would have thought that would have increased in
Yeah,
2021.
that doesn't make sense to me at all, to be honest.
Yeah. Well, we'll ask Tavi about that next time we have him on the show. NASDAQ 100 S&P, gold supply cliff. And so obviously that brings us to basically figuring out what Tavi is largely having in his book, which is clearly gold names. He's a buyer into this idea of a commodity super cycle. All right, Jay, let's wrap it up here. What else you got going on this afternoon over at the Dive?
This afternoon, we have Mark Chandler from Mark to Market on the Daily Dive. And beyond that, I've got nothing scheduled. So it was a long weekend. So typically long weekends just blow out my backlog in terms of what I hold back for future publishing so that we're fairly consistent. Hermina just sent something over. I don't even know what it is yet. So that'll be out.
Okay.
Go from there.
Well, I just want to reiterate the fact that nothing we talk about on here is financial advice, not a buy, a sell recommendation. You look for that sort of thing, go find somebody who's licensed. We are not licensed. This is informational, entertainment purposes only. It's on a best efforts basis, the information we talk about. Look, I appreciate all of you that joined us for the last hour. You could have spent your last hour staring at any screen, any place in the world, but you chose to spend it with us. I sincerely appreciate that. Tomorrow, we're in talks of doing 3 live shows in one day. We're going to be focusing pretty heavily on Michigan. I believe we got Daniela from, I think she's with Stansberry now. We're going to get to interview her. So that's going to be an exciting interview. That's going to be at noon. And then we got the CEO, I think his name's Fabian from Gage is going to be joining us at 2 p.m. Really excited about that. Jay's playing at 4 p.m. I'm sure that nobody listening actually cares about that other than me, but that's what I'm excited about. Guys, I don't know if any of you are watching the markets or watching our show today, but you know what? I appreciate those of you who did. You could have spent your last hour staring at any screen, any place in the world, but you chose to spend it with us. And for that, I appreciate every single one of you. We'll be back tomorrow. Thanks for joining us.